Hey, Grayson, how are you?
I'm doing well, Andrew. Thank you. How are you?
Yeah, I'm doing well. Great to have you back on the podcast. It's been a while since you and I have chatted on here, but it hasn't actually been that long since talking about the U.S. equity portfolio. Our last episode on the U.S. was back in May this year. And at that time, we talked about the strong market performance in the U.S. to that point, which has obviously continued its ascent, albeit at a slower pace than the first half of the year. Let's start there and give our listeners a feel for what the market has been doing under the surface of the strong returns so far this year.
So, I'd say there's been three big themes driving the US market over the past 6 months, but even longer. Interest rate and inflation, artificial intelligence or AI, and more recently, the election. So let's talk about those three. First, inflation and interest rates. Over the pandemic, we saw food, energy, goods inflation rise. Think about things like basketball hoops, ping pong tables, lumber for decks. So that's really subsided over the past 6 months or year, which is not surprising. People have enough of that stuff. And a lot of them have spent their COVID savings or the government checks. What we are seeing stick around a little bit longer is service inflation. So this has been falling very slowly, but it's still fairly high at around 3%. So this includes a lot of items that are pretty sticky, things that you might not see relief for in the short term. So think about things like rent, home insurance, car insurance, education, medical services. So you probably sign a lease for your apartment for a year, or you're same with insurance or education. So you're not going to see those costs come down until you renew your lease, and maybe not even then. Wage inflation has been reasonably strong as well. You're seeing real wage inflation of 1% to 2%. So people are still making more money. And you combine that with unemployment being pretty low. It's below where it was in 2000 and in 2007, and just above where it was in 2019. So if you have a job and you're making money, it's usually a pretty good setup. You can get squeezed in the short term if costs rise faster than your earnings, but it's usually pretty decent. Now, it's a little bit different for low-income families. Their discretionary income is already fairly low. And so if food costs go up 15%, or your rent goes up, or your car insurance, you really start to see the squeeze. And we've seen a little bit of that over the past kind of six to 9 months with stores like Target, dollar stores calling out lower income families as being in a pretty tough spot. So if unemployment starts to rise, we could run into problems. And since we're long-term investors, what's the long-term outlook for inflation? Well, it seems like, while it may be subsiding in some ways right now, a lot of the drivers of longer-term inflation are still out there. Deglobalization still seems to be a problem, tariffs, war. So that's inflation. The second big theme that's impacting the US this year is AI, and specifically NVIDIA. NVIDIA is kind of the poster child of artificial intelligence, and it's really been driving the market since ChatGPT was released. And NVIDIA is up nearly 10 times from late 2022, and it's pulled up the S&P 500 since that time as well. So the S&P 500 is up about 60% since then. Now, since about mid-year 2024, we've seen NVIDIA start to yo-yo a bit. It's been down anywhere from 5% to down 30% over that period. And I guess the real question now is AI a real trend? Probably is the answer. We've gone through that kind of initial hype stage where people are super excited about kind of a paradigm shifting technology. But that hype often outruns reality in the short term. Think about if you look back over the years to things like e-commerce back in the 90s with companies like Amazon. Amazon took a decade for its stock price to get back to where it was in the late 90s. So, a great theme. Everybody could see that e-commerce was going to be a theme that's kind of stuck around, but doesn't mean that the stock does well over that period. Same with internet fiber back in the 90s. And more recently, you've seen it with themes like blockchain and Bitcoin, which have been really hyped up. Self-driving cars. These technologies are likely going to be critically important in the future. It's just maybe not quite yet. And so that's the question with AI. Is it overhyped or is it not? And you can see when you look at a company like NVIDIA, where you have to pay 55 times earnings for a nearly $3 trillion company, that it's not super cheap on the surface. So we'll see what happens, but it seems like the market is a little bit less certain about that than it was 6 months ago. The third theme is the election. This one, I think, has a bigger impact than some people believe. It really seems like democracy is on the ballot this go around. When you look at the two candidates, some of the stuff that Trump is talking about, massive tariffs on Chinese goods, halting immigration, perhaps even putting opponents in jail, a big increase in spending. These are all really inflationary changes to the economy. Harris's agenda is also pretty inflationary, but for pretty different ways. So we could see a lot more uncertainty with the upcoming election, even than what you normally see in an election cycle. But the good news is the US has survived a lot of challenges before and democracy has prevailed. So hopefully it does this time too. So those are the three big shifts, Andrew. AI, inflation, and the election coming up.
Well, since you mentioned it, clients and listeners are always curious about the impact of the election in the US. I don't mean to make a comment on your age here, but you've been at this through several presidential changes at this point. How do you manage through election cycles and the potential for changing leadership every 4 years?
You've probably heard this before. Well, I know you've heard this before, but many listeners have probably also heard this before. It's really about preparing and not predicting. So it's really hard to predict the outcome of an election. Even pollsters get it wrong, and that's their full-time job. And then, of course, you need to forecast what's going to happen if a certain person gets elected. What will happen after they get elected? What kind of policies will they implement? How will the markets react to those policies? So it's really tough to know what to do. So what do we do? Two things come to mind. One, avoid sharp edges, and two, diversify. So one, how do we avoid sharp edges? Well, we avoid industries and companies that are highly dependent on one outcome. This could be things like companies that import goods from China that could get crushed by tariffs. This could also be companies that export goods to China that could be hurt by a retaliatory backlash. So a couple of things come to mind. If you look at big exports to China from the US, one of them is soybeans. So about 60% of soybeans that are exported from the US go to China. So you'd want to be careful if you were investing in soybeans, for example. Vehicles could be another one. About 20% of vehicles that get exported out of the US go to China. So if you're investing in a vehicle manufacturer, you'd want to check that out as well. The second is diversify. You could invest in a pipeline owner or a supplier to a pipeline. Winning or losing is going to be highly dependent on who gets brought into power in an election. We would rather buy companies that are diversified. So healthcare is often an industry that comes up in election discussions. And we've decided to invest in healthcare companies that are highly diversified. So think about ones like United Health. They have a top-tier management team enabling them to adjust and benefit from any changes that might happen. So they have a highly diversified business model. And of course, many of our US holdings are globally diversified. So ones that come to mind would be Procter & Gamble, who owns brands like Tide and Pampers diapers. So over half of their sales are outside of the US. Microsoft would be another one. Nearly half of their sales are outside the US. Even businesses like futures exchanges that are kind of less consumer facing. We own a company called CME. And when you look at the different asset classes that they run, about a third to a half of the volumes are from outside of the US for those futures exchanges. So diversification is really important. So yeah, Andrew, the ways we've done it, risk management through avoiding sharp edges and risk management through diversification.
Well, let's stay on the topic of diversification. It's obviously one of the most important lines of defense for an investment portfolio. What does that look like in a so-called single geographic asset class like the US portfolio?
Yeah, great question. Lucky for us, the US is highly diversified for a single country. There are two big drivers to this diversification. One, diversification by geography. So at first that sounds kind of funny, right? Because it's just one geography, as you mentioned. But the US is fortunate in that it has a ton of multinational companies. So their strength of product and brand allows them to sell globally. Companies like Nike, Amazon, Pepsi. And of course, there's ones that have smaller brands too. So companies in our portfolio like Amitech would sell their high-speed cameras, their ultra high-speed cameras globally. Or companies like ITT would be selling brakes for automobiles and pumps for industrial uses globally. So while it seems like it's not diversified by geography, it really is due to the products, the brands that come out of the US. The second is diversification by industry or even kind of sub-industry. So the US is in a great position because they have unparalleled breadth of companies and industries. So smaller economies often tend to lean heavily on a small number of industries to generate much of their GDP. For example, our home country of Canada is pretty resource intensive. So it leans on a lot of commodity industries as well as the banking sector. But the US has far more options. So even for small industries like materials, for example, there's impressive diversification. So in materials, we could buy oil and gas exploration companies. But in the past, we've also bought companies that make software that helps manage refineries. We currently own an aggregate company that would fall under the materials umbrella that produces rock that goes into infrastructure and buildings. The US also has diversification through industries like healthcare and technology. So these industries tend to be a lot smaller in a lot of countries globally. So healthcare could include companies like pharmaceutical companies like AbbVie or companies like Abbott that make medical devices such as continuous glucose monitoring devices for diabetes, or it could include drug distributors like Cencora or needle manufacturers like Becton. So even within that one sector in the US equity strategy, there's a wide diversification of companies.
So diversification is clearly an important aspect contributing to attractive long-term risk-adjusted returns. And as we talked about earlier, it can be an antidote to volatility through different periods, like elections. Maybe building on that theme of changes at the executive level, when you're looking at the portfolio or out into the broader market, I know that you and the team have an alert that lets you know there have been changes in the C-suite of companies within your investable universe. How does that help you? And ultimately, how do you factor in the leadership changes when evaluating a company's long-term prospects?
Yeah, that's right. Yeah, we created an alert system that notifies us of many things, including management changes. So why is that important? Well, for long-term investors like ourselves, management and culture drive a significant amount of value for two key reasons. One, the management team reinvests the cash flows generated by these businesses. So as you know, we focus on highly cash generative businesses. So there's typically a lot of cash to invest. And the management team has to decide to either give that back to shareholders through buybacks or dividends, or to grow the business. And so that's going to be really important over a 5 or 10 year time period. They also help to manage risk. So having a good management team can help the business adjust to competitive changes. It can help the business manage their costs, especially in a tough environments like a recession. And they can help in managing leverage on the balance sheet. So why do we monitor these changes? Well, some people are better than others, frankly, and there's different people that have different priorities. And so when we look down our portfolio, we think we have a lot of top-tier management teams, ones like Amphenol, Amitech, Gallagher, Accenture, Texas Instruments come to mind. But when key parts of that management team change, we want to make sure our thesis on the management team is intact. And that's partly because we might have to adjust our management score in our proprietary matrix. And if we change our score in that can impact the weight in our portfolio. So depending on the significance of the change, we will often speak to the CEO, the CFO. We'll listen to them on conference calls or presentations just to get a sense for how they think about things. We might talk to former colleagues of theirs to see how they rate them, what their interactions are like. And we're really trying to find out how much value this person and this team are going to add over the next 5 years. So management are clearly very important drivers of the value of a company. So we think it's important to monitor the quality and the motivations of the management team. And if you look over the past 5 years, we've spoken with the more research team has spoken with nearly 1,500 US management teams over that time period. So we think we have an edge in understanding management teams. And so it's important to monitor that on a real-time basis.
Yes, management can certainly make or break the long-term success of an investment. Just before I let you go, one stock that is relevant to highlight today because it hits on some of the themes that you've discussed already is AJ Gallagher, which is involved in both insurance as well as risk management. Tell us more about that holding.
For sure. AJ Gallagher is a company with it's a great business, has a great management team, and we think it trades at an attractive price. So how is it a great business? Well, they're an insurance broker, and so they're trying to help businesses find the best insurance for their needs. And this is a great business because you can benefit from the characteristics of the insurance industry without having to take balance sheet risk. So you think about an insurance company, they're on the hook to pay out claims, but brokers aren't. And so brokers are able to benefit from some macro shifts we're seeing, like climate change, for example. You see more forest fires and floods. Things like this lead to higher insurance premiums because the money has to come from somewhere. So you have to pay more money for your insurance, and then the claims paid out are higher. General inflation, you're seeing rising labor costs. You're seeing building material costs go up. You're seeing a more litigious society in general. So all these factors lead to higher insurance premiums. And a company like AJ Gallagher, their revenue is based on insurance premiums. So some of these changes are good for them. The insurance cycle is also a different cycle than the economic cycle. So this is very helpful for the resiliency of our portfolios. Second, how is the management team great? Well, I point to two things. One, culture. Gallagher has a pretty unique culture. They have a strong sales culture, and they have a cultural credo they like to call the Gallagher way. They're also excellent at capital allocation. So they've done a lot of savvy acquisitions over the years. These have primarily been smaller ones, which lowers the risk to them. But there's also been some larger ones, like they recently did a Willis Re acquisition, where they're able to take advantage of the kind of botched acquisition between Aon and Willis and snag an excellent asset at a pretty attractive price. So yeah, we believe they have a great management team. And then lastly, it's great that they have an excellent management team and an excellent business, but we want to make sure we pay the right price for that. And so we've run it through a detailed discounted cash flow analysis, DCF model. And that's helped us determine the price that we want to pay for an asset like this. And you look at the price it's traded at over the past several years, we don't think that price has properly reflected the quality of the business and the quality of the management team. And so that's why we've been happy owners of AJ Gallagher for the past 5 years.
Well, I always like ending on a note talking about the bottom-up process and the holdings that make up our portfolio. So let's wrap it up there. Grayson, always great catching up with you. Thanks for taking the time to come on and chat about the portfolio.
Thanks, Andrew. It was fun.